On the 18th of March 2026, the Federal Open Market Committee voted to hold the federal funds rate at 3.5 to 3.75%. The vote was 11 to 111. Officials looked at the same economy, the same inflation data, the same labor market, and said hold. One looked at the same numbers and said cut. That one vote came from Governor Stephen Miran. And the reason it matters is not because one person disagreed. Disagreements happen. It matters because of what Miran sees that the other 11 either do not see or have chosen to set aside. The source for that vote count is the Federal Reserve's own post-meeting statement, released at 2 p.m. Eastern on the 18th of March. The source for what comes next is a series of public speeches, meeting minutes, economic projections, and market pricing data that, when placed side by side, tell a story the headline does not. Before going further, a note: this channel does not give financial advice. Nobody here is a licensed advisor. Nobody here knows your situation. And nothing said in this video should be treated as a recommendation to buy, sell, or hold anything. This is a breakdown of public data and public statements. What you do with it is your decision. Evidence 1. The February jobs report released the 6th of March by the Bureau of Labor Statistics showed non-farm payrolls declining by 92,000. That was the first negative monthly print since December 2020. Wall Street had expected a gain of roughly 50,000. The number came in 142,000 jobs below consensus. Healthcare employment dropped, reflecting ongoing strike activity. Federal government payrolls continued to fall. The unemployment rate ticked up to 4.4% from 4.3%. That report landed 12 days before the March FOMC meeting. Every voting member of the committee had it. Miran, in a CNBC interview that same day, said the data added to the case for more rate cuts. He said the Fed should be focusing more on supporting the labor market than worrying about inflation. Nobody posts about being afraid of a recession on social media. People just start checking their bank accounts more often. Then the March jobs report came out on the 3rd of April. Payrolls rose by 178,000. The unemployment rate edged back down to 4.3%, and the February number was revised, not up, down, from negative 92,000 to negative 133,000. The hole got 41,000 jobs deeper after the fact, and hardly anyone noticed, because the March headline was positive, and that was the number that made the evening news. This is Miran's argument in miniature. The labor market data is not just soft. It is being revised softer, and the revisions do not get their own press conferences. Evidence 2. In January, Governor Miran was not alone. Governor Christopher Waller also dissented, voting for a 25 basis point cut. The January vote was 10 to 22. Governors looked at the data and said this economy needs relief. By March, the vote was 11 to 1. Waller switched. He voted to hold. Miran stayed. The question is not why Miran dissented. The question is why Waller stopped. The answer, or at least the most likely version of it, is the war. On the 28th of February, the United States and Israel launched strikes against Iran. Within days, oil shipping through the Strait of Hormuz was disrupted. Crude prices jumped more than 50% from pre-war levels. The inflationary shock was immediate and obvious. For a central banker weighing the dual mandate, cutting rates into an oil spike is not an easy argument to make. Waller apparently decided it was not an argument he wanted to make in March. Miran decided it still was. Governor Miran told Bloomberg on the 23rd of March that the central bank should not set policy based on short-term oil shocks. He said the Fed should look through the energy price spike the same way it looks through other temporary supply disruptions. In January, Miran had called for about 150 basis points of easing over the course of the year. According to Reuters, by late March he had scaled that back to roughly 100 basis points, or about 4 quarter-point cuts, telling CNBC on the 30th of March that he still thought rates could be about a point lower. The war did not change his direction, it changed his magnitude. The economy underneath the oil shock, he argued, still needed support. There is something worth pausing on here. Not every dissent is a protest. Some dissents are a forecast wearing a different coat. What Miran is doing is placing a bet, in public and on the record, that the labor market deterioration is the real signal and the inflation spike is the noise. Evidence 3. The March plot 19 FOMC participants submitted their individual rate projections. The median estimate for the federal funds rate at the end of 2026 was 3.4%. That implies one 25 basis point cut this year. But the median conceals a split. 7 of 19 participants projected no cuts at all in 2026. One more than in December. The distribution is widening. The committee is not moving toward consensus. It is moving away from it. The summary of economic projections published alongside the dot plot showed officials raising their 2026 inflation forecast to 2.7% on both headline and core PCE. They also nudged GDP growth up to 2.4% and held the unemployment rate projection at 4.4%. In other words, the committee's central case is an economy growing at a decent pace, with inflation still running well above target and a labor market that is soft but not collapsing. Miran's central case is different. He sees a labor market that is deteriorating beneath the surface and an inflation overshoot that is temporary. The dot plot says most of his colleagues disagree. The revisions to the February payroll say the data is closer to Miran's red than the median dot would suggest. A household earning $82,000 a year does not think about the dot plot. A household earning $82,000 a year thinks about whether the next round of layoffs includes their department. Evidence 4. The FOMC minutes from the March meeting were released on the 8th of April. The word that appeared in the coverage was hawkish. Reuters reported that a growing group of policymakers felt rate hikes might be needed. The minutes used the word some to describe officials who favored opening the door to upward adjustments in the funds rate. At the January meeting, the corresponding word was several. Some is more than several in Fed speak. The direction of travel inside the committee is not toward Miran. It is away from him, but the same minutes contained a counterweight. Most participants raised the concern that a protracted conflict in the Middle East could lead to further softening in labor market conditions, which could warrant additional rate cuts. Higher oil prices could reduce purchasing power, tighten financial conditions, and reduce growth abroad. The minutes, read in full, do not point one way. They point both ways at the same time. And this is where most people stop reading the minutes. The Fed is not split between hawks and doves. It is split between two definitions of the problem. One group sees inflation as the primary risk and believes holding rates or even raising them is the appropriate response. The other group sees a labor market that is quietly deteriorating and believes that waiting too long to cut will cause damage that rate cuts cannot reverse. Both groups are looking at the same data. They are not looking at the same economy. Every financial institution with a stake in the direction of rates has a structural incentive to emphasize the scenario that aligns with its positioning. The institutions calling for no cuts are not lying. The institutions calling for cuts are not lying either. They are each reading the data through a lens shaped by their own exposure. The Fed is supposed to be the institution without a position. Right now, it is an institution with 19 positions and no majority. Evidence 5. On the 6th of April, Wells Fargo Investment Institute formally revised its outlook. It no longer expects the Federal Reserve to cut interest rates in 2026. The stated reason was uncertainty around inflation and heightened geopolitical risk tied to the Middle East war. Earlier in the year, Wells Fargo had been forecasting 2 rate cuts in the second half. That forecast is gone. Meanwhile, on the 7th of April, Reuters reported that most major Wall Street brokerages were sticking with forecasts for 2 rate cuts in the second half of the year. 2 large institutions, looking at the same war, the same oil prices, the same minutes, reaching opposite conclusions published one day apart. Then, on the 8th of April, the United States and Iran agreed to a 2-week ceasefire. Oil prices dropped more than 15% in a single session, with West Texas Intermediate falling to around $92 a barrel according to market data. Market pricing for a rate cut by December shifted back toward 1 reduction. Polymarket showed a 41% probability of no rate cuts in 2026. Swap markets, which had briefly priced 0% probability of any cut after the March meeting, began to reprice. The ceasefire did not change the fundamentals, it changed the mood. And the Fed does not make policy based on mood, or at least it says it does not. Here is what the evidence chain looks like when assembled. The labor market lost jobs in February. The loss was revised deeper by 41,000 a month later. March bounced back, but not enough to erase the revision. Core PCE inflation sat at 3% in February, according to the Bureau of Economic Analysis, up from 2.8% in November, and a full percentage point above the Fed's target. The Fed's own median projection sees only 1 cut this year. 7 of 19 officials see none. The minutes reveal a faction considering hikes. The lone dissenter wants roughly 100 basis points of easing. The war scrambled everything. The ceasefire unscrambled part of it, and the next MAMCMC meeting is the 29th of April. The core PCE price index has been above 2% since early 2021. 5 years, 5 consecutive years above target. For a central bank whose sole inflation mandate is 2%, that is not a blip, it is a condition, and it is the condition that makes Miran's argument so difficult to win inside that room. He is asking his colleagues to look past 5 years of above-target inflation and focus on a labor market that might be weakening. Most of them are not willing to do that. Not yet. Consider someone named Sage. 34 years old, works in logistics coordination outside of Columbus, Ohio. Earns $61,000 a year, has a 5-year-old car loan at 4.9%, $23,000 in student debt at 6.8%, and a 1-bedroom apartment at $1,400 a month. Sage has been watching the same job postings recycle on LinkedIn for 3 months. 2 colleagues in the same department were let go in January. The department has not backfilled. Sage's savings account holds about $8,000. Sage checks it maybe once a week now, which is more often than 6 months ago. Sage does not know what the federal funds rate is, but the federal funds rate knows exactly where Sage lives. By every conventional measure, Sage is doing what the system asks. Employed, paying bills, carrying manageable debt, saving a small amount each month. The economy the Fed describes in its projections includes Sage as a data point in the 4.3% unemployment rate. The economy Sage actually experiences includes a department that got smaller and a rent increase, notice that arrived on the first of the month. That is who the dissent is about. The Fed funds rate is a single number that touches 330 million lives differently. When Miran votes to cut, he is not making a prediction. He is making a prioritization. He is saying the people who are losing jobs and watching their departments shrink matter more right now than the people whose grocery bills went up 8% because of an oil shock. The other 11 are saying the opposite. Both positions have evidence. Neither position is without cost. The ceasefire, if it holds, removes one variable, oil drops. Headline inflation eases. The pressure on the hawks softens, but core inflation does not respond to ceasefires. Core inflation responds to demand, wages, housing costs, and expectations. And core PCE is at 3%. If the ceasefire collapses, oil spikes again. And the committee is back to the same impossible choice with less time and less room. And here is the part that should keep the next meeting interesting. Jerome Powell's term as chair expires on May 15th, according to Federal Reserve records. Kevin Warsh, his nominated successor, has indicated a preference for lower rates but has not made a public statement since the war began. Senator Tom Tillis has said he will block Warsh's confirmation until the Justice Department investigation involving Powell is resolved. Powell himself told reporters on the 18th of March that he has no intention of leaving the board until the investigation concludes with transparency and finality. His seat on the Board of Governors does not expire until January 2028. The person running the next meeting might be the same person who ran the last one. Or it might be someone new with a different read on the same data and a different number of votes in the room. The system did not design a way for 330 million people to participate in this decision. It designed a way for 12 people to vote and for the rest to find out afterward. That is how monetary policy works. Whether that design serves the public is a separate question the public does not get to vote on. On the 29th of April, the committee meets again. The same inflation data, a new jobs report, possibly the same chair, possibly not, oil at 92 or 120, depending on a ceasefire that is 14 days old and already showing strain. One governor looked at all of it and said cut. The question is not whether Miran is right. The question is what happens to the people in the 4.3% if he is, and nobody else voted with him until it was too late.